Let us quickly revise, guys, derivatives. I might not revise the entire chapter today as such, but we will revise to the extent possible. The ones who are watching it on YouTube as such, guys, later. For you guys, it will anyways, the video will be merged. It will be as a single video, guys. Whatever names that we are using in this beta or whatever names that you see on the screen as such, guys, are the names of the previous batch students and not the names of this student, because the document beta that I'm referring to is from the previous batch. So, derivative, guys. The first thing that we have learned under, तुम्हारे concept notes भी दो बेटा मेरे को please. Start से ना ये. The first thing that we have learned as such, guys, under derivative was construction of an index, because a lot of questions of derivatives as such, guys, were based on index. I said index as such, guys, is basically beta a relative value that tracks the changes in the values of the underlying commodities. Just inflation is an index, consumer price index beta is also an index, wholesale price index is also an index. For us, beta, when we say stock market index, I told you stock market index beta will be based on certain companies and the market capitalization of those companies. You do not take overall market capitalization, you take free float market capitalization as such, guys, in order to arrive at the index value. Whenever an index is started as such, guys, just as I told you, when Nifty commenced as such beta, the base value that was considered as such, guys, was 1000. When Sensex started as such beta, the base value that considered was 100. Why were different base values considered? Sensex 1979 mein aa gaya tha, Nifty came into existence in the year 1995, guys. So imagine there's a total market capitalization as such beta is 1000 crores and we see the base and we set the base value as 100. If the overall market value as such, guys, is increasing to 1020 crores, proportionately beta index will increase to 102. But this should be based on what? Free float market capitalization. It cannot be based on total market capitalization. What is free float market capitalization? Anything other than promoters holding as such beta will come under free float market cap. If promoters holding is 55%, the remaining 45% as such beta should come under free float market capitalization. After that beta, we moved on to the definition of the word derivative. I said derivative is any instrument beta that is not an instrument on its own but derives its value from an underlying asset, from an underlying variable. Anything whose value is dependent on an underlying variable will be termed as a derivative instrument. If I am entering into a contract as such, guys, to buy 1000 shares as such, guys, of say Reliance Industries as such, guys, from Nandini after 3 months, this contract that we are entering into as such beta will become a derivative instrument, because as the price of the underlying shares of Reliance as such, guys, will keep changing, the value that we are going to derive as such beta will change. If the price is increasing, I will be at an advantage, Nandini will be at a loss as such, guys. If the price is reducing, I will be at a loss and Nandini will be at a gain. So anything that is deriving its value from an underlying asset as such beta will become underlying variable, will become a derivative instrument. The prima facie objective of creating derivative instruments beta was to hedge our risk. So we say that there are 3 uses of derivatives. It can be for the purpose of speculation, it can be for the purpose of hedging, or it can be for the purpose of arbitrage. When you say beta that you're entering into a derivative instrument for the purpose of speculation, I do not have any underlying risk. I am only betting on price increase or decrease. Just if someone is of the opinion that for the time being the virus ka situation, guys, is going to worsen, then what will be your expectation? Markets should crash further as such, guys. If you're expecting the markets to crash further and you want to bet on account of this, guys, what should you do, guys? Create short positions. You will sell the index first as such, guys, or you will enter into forward contracts, jo bhi hai beta, to sell first and buy back on a later date. If you sell at a higher price and buy back at a lower price, you will obviously gain on account of that. But provided your expectation holds good. If markets go against your expectations as such, guys, then you will end up incurring a loss. That is called as speculation. Hedging beta is wherein you have an underlying receivable or a payable. Just say, guys, you had foreign currency AS11, guys. I have sold goods to someone sitting in US. I have a receivable of $1 lakh. The value that I'm going to derive from this $1 lakh beta will also depend upon the dollar rate. I do not want that risk. So I'm entering into a contract with the banker now only that I will sell those $1 lakh to my banker at a predetermined rate. Now the contract that I've entered into with my banker is a forward contract. Yes, but this contract as such, guys, is not for the purpose of speculating on anything. It is for the purpose of reducing my risk. Arbitrage beta on the other side, guys, arises when the product is mispriced in 2 different markets. For us, the 2 different markets beta are cash market and derivatives market. So if the product is mispriced in the cash market and derivatives market, we will take opposite positions in the cash market and derivatives market, guys, and try to gain on account of that. Riskless profit beta is called as your arbitrage. After that beta, I told you that derivatives are broadly classified into exchange traded derivatives and over the counter derivatives. Exchange traded derivatives as such guys will reduce credit risk. You are not directly entering into a contract as such beta with another party. It is being done through the stock exchange. Both the parties who are entering into contracts as such guys will have to pay margins or will have to make payments upfront guys. This is how credit risk is reduced. But exchange traded derivatives will all be standardized contracts. You cannot change the terms of the contract. Over the counter derivatives is a direct contract between one person and another person beta, and that is why they can be customized. If you are entering into a forward contract to sell $1 lakh with the banker, that will be over the counter derivative. It is not exchange traded. Isn't that a direct contract between you and the banker? So exchange traded derivatives के common examples beta are futures and options. Under over the counter beta you will have forward, swaps and swaptions. We are going to learn about swaps and swaptions later guys when I do interest rate risk management. As of now, okay, these are the different categories guys. After that beta I spoke about long position and short position. ये तुम्हारे लिए बेटा I spoke about long position and short position in security valuation only. There was a question guys in which we created short position. Let us quickly revise. तुम्हारे ये current concept notes में you will not have long position and short position. Different batches में बेटा explain the concept at different places. What is long position? You buy first and you sell later. What is short position? You sell first and you buy later. Short positions can be created as such guys in the market only when delivery is not required. So that is why beta we say that short positions can be created in derivative segment. In derivative segment, if someone is buying, the other person is selling. It's a long position for one and short position for the other. In cash market as such beta, you cannot create short positions unless it is for intraday trading. Intraday trading में क्या करोगे बेटा? You can sell in the morning and you can buy back in the later. Delivery के लिए how are you going to create short position in cash market? Stock lending and borrowing scheme. I said you will have to borrow securities from someone better first and then sell them in the market. That is how you will create short position in the cash market. Are we clear about this? After this beta we moved on to the very first derivative instrument, that is future or a forward. A future or a forward contract is a contract to buy or sell an underlying variable at a predetermined price on a later date. It creates an obligation to both the parties. You do not have any right here. If I am entering into a contract to buy shares of Reliance at a price of 1400 rupees as such from Nandini 1 year later, the price is predetermined, the time period is predetermined, the quantity is predetermined. No matter what happens as such guys, we are going to execute this contract after a year at a price of 1400 rupees. If the price of Reliance is more than 1400, I am going to gain. If the price of Reliance is less than 1400, she is going to gain. Are we clear about this guys? So that is a forward contract. In order to arrive at the value of a forward contract as such guys, I said the variables that are involved is what is the price of the underlying security today, what is the risk-free rate that is prevailing in the market, what is the time period, and what is storage cost or income of the underlying commodity. Forward price, the price at which the contract will be entered into, is the likely price that is going to prevail on a later date. If there is no underlying storage cost, if there is no underlying income of the security, fair forward price is simply the compounded value of the spot price that is prevailing in the market. If the spot price, जैसे screen पे दिख रहा है बेटा यहाँ पे, spot price is 19,901. This was the Nifty 1 year back when I was taking that batch as such guys. Spot Nifty is 1905 guys, 19,901. If the time to maturity is 70 days, we have simply added time value component for those 70 days guys and determined the value of forward. So if there is no underlying income, how are you going to arrive at fair forward price beta? Ek second. Your fair forward price will simply be the compounded value. That is why you will write S0 into 1 plus R whole power T. This is if it is discrete compounding guys. If it is continuous compounding, you are going to write S0 into e power RT. If they give us e values in the question, we are going to assume that it is continuous compounding. Otherwise, beta, it will be discrete compounding. If compounding is done more than once in a year, instead of writing S0 into 1 plus R whole power T, you are going to write S0 into 1 plus R by M whole power T into M. This formula, I repeat again, can be used if the underlying security does not involve any storage cost or does not result in any income. If the underlying security as such, जैसे यहाँ पे if you see the example as such better, depending on the maturity period, we have determined as to what is going to be the likely future price, spot price के basis पे. If the underlying security as such, guys, results in dividend income, I told you whenever a company declares dividend, the price of the security in the market beta is going to reduce to the extent of dividend declared. Because the price of a security as such, guys, is going to reduce, we are supposed to adjust this dividend income, guys, from spot price. But dividend income as such beta may not be declared today. If dividend income as such, guys, let us say beta today's date as such, guys, is 1st of Jan 2025 as such, guys, and dividend of a company is expected on 28th of Feb 2025, forward contract is expiring on 31st of March. Okay. As on 28th Feb as such, guys, the price of the security is going to reduce to the extent of dividend income. In order to make that adjustment as such, guys, I said, ye S naught hai. What are you going to do, guys? Discount this dividend income for how many months? Discount the dividend income for 2 months. Once I discount dividend income for 2 months beta, then what should I do? From spot price, you will remove the present value of dividend income and then compound this difference as such, guys, for how many months? 3 months. Whatever is the net difference has to be compounded for 3 months. This is how we are going to adjust dividend income of the underlying security, guys. Are we clear about this? But if the question mentions that dividend is payable before expiry, you assume that dividend is directly payable 1 day before expiry, guys. If dividend is payable on 30th of March 2025, there's absolutely no sense in discounting it for 3 months first and then again compounding it for 3 months. What will you do instead? S naught into e power RT, compound your spot price and then deduct the entire amount of dividend income. This is how you're going to get fair forward price of a security beta that pays dividend income. Either S naught minus I into e power RT or S naught into e power RT minus dividend. First वाला कब use करेंगे? When they exactly specify the date on which dividend income is being given. When will you use the second one? When dividend is paid just before expiry, we are going to use the second one. If the underlying security is something that is subject to storage cost, इसको हम लोग बोलते हैं carry type commodity. All right. If the underlying security is subject to storage cost, beta, that storage cost is going to increase the price of the commodity. So exactly similar to dividend, guys, but instead of deducting it, we add it. You will write S naught plus S, where S is the present value of storage cost into e power RT, guys. To spot price, you're supposed to add the present value of storage cost and then compound the entire summation as such, guys, for the period of the forward contract maturity. Are we clear about this? This is computation of fair forward price. So it is directly either S naught into e power RT, or it is S naught minus I into e power RT, or it is S naught plus S into e power RT. Assuming that it is continuous compounding. If it is discrete compounding, you will write into 1 plus R whole power T. Apart from this, I also told you guys, if income is not given in absolute terms, instead dividend yield is given. That dividend yield beta should be reduced from your borrowing cost and the net borrowing cost will be considered. Let us say that your borrowing cost is 10% and yield is 7%. You will take 10 minus 7, directly take the difference as 3% and take that dividend yield for computation of your fair forward price everywhere. Are we clear about this? Now guys, what do you think will happen to the difference between spot price and forward price as the time to maturity reduces? The difference between spot price and fair forward price is purely on account of time value component. So as this time value component reduces as such, guys, obviously the difference also will reduce. On expiry date, your fair forward price will always be equal to spot price. That is why, guys, whenever we settle a forward contract, it can either be delivery settlement or it can be cash settlement. Let us go back to the example beta that I have entered into a contract with Nandini, guys, 1000 shares at a price of 1400. अगर डिलीवरी सेटलमेंट है बेटा, भाड़ में गया, what is the price prevailing on expiry date? All that I should do beta is pay 1400 rupees to her and take share of Reliance. 1000 multiplied by 1400. I will pay and I will take delivery of the underlying shares. If it is cash settlement, guys, we are not going to exchange the underlying commodity. Instead, we will settle the net difference in cash. This will depend on the price that is prevailing on the expiry date. Alright, guys. If the price prevailing on expiry is 1500, Rahul will receive 100, Nandini will have to pay 100. If the price prevailing on expiry is 1300, Rahul will lose 100, Nandini will receive. Our agreed price is already 1400. We are settling the contract at what price? Price prevailing on the expiry date. Why are we settling it at price prevailing on expiry date? Because on that date there will not be any difference between spot price and future price. ये समझ में आया? Physical settlement and cash settlement. If at all they specify better that the spot price on expiry is not equal to future settlement price, compulsorily cash settle. You should take future settlement price. You cannot take cash settlement price. There were 1 or 2 questions in relation to rice futures. You entered into a contract bet at 58. On expiry date, they gave us different spot price and different future settlement price. याद है वो rice वाला question? So there you cannot do settle it at spot price prevailing on expiry. You will have to compulsorily settle your futures contract at future settlement price. याद रखना, for a long position, price increase is a, if you have a long position, price increases, it is a gain. Price reduces, it is a loss. If you have a short position, price decrease is a gain. Price increase is a loss. Now the other important part. If at all you are settling your future contract before expiry, will you settle the contract, guys, at future settlement price, or will you settle the contract at cash price? Future price. Imagine that I have entered into a future contract beta on 1st Jan, contract that is expiring in the month of March futures. If I want to exit the contract beta on 1st of Feb, I still have to exit March futures only. Can I exit at the spot price prevailing on 1st Feb, or should I exit at March futures price prevailing on 1st Feb? There were 1 or 2 questions, guys, in which we exited from the futures contract before the expiry date. Whenever they say that you are exiting from a futures contract before the expiry date, first come, क्योंकि तुम लोग गलतियां क्लास में किए बेटा, you directly exited at spot price. I said you cannot exit at spot price. First step is to recompute fair future price based on remaining maturity. Original maturity was 3 months. Remaining maturity is 2 months. So as on 1st Feb, you should recompute what is the future price prevailing based on that remaining maturity of 2 months and then exit the contract at that price. Are we clear about this? This will come better when you are exiting from a contract before expiry. ये हो गया about pricing of futures. Settlement on expiry, settlement before expiry, cash settlement, delivery settlement. Now talking about arbitrage opportunity, guys. Then we'll talk about hedging. Did we learn about arbitrage under this? What did I tell you beta? You're supposed to compare actual forward price with fair forward price. If your actual forward price is greater than fair forward price, forward is overpriced. You can enter into a contract only at actual price. You cannot enter into a contract beta at fair forward price. So if forward is overpriced, if actual forward price is more, whatever is overpriced, you always sell it. So you will sell forward, you will buy spot. Because you are buying spot as such beta, you will need money, and that is why you will, in most of the questions, you will only have to write this statement and leave it. Unless and until they ask us to show how are you gaining on account of this mispricing. Likewise, if actual forward price is less than fair forward price, your actual forward beta is underpriced. Because forward is underpriced, what are we going to do, guys? You are going to buy forward, you are going to sell spot. Because you are selling spot, you will need money, guys, and sorry, you will receive money, and that is why you will, I said this is all possible practically, as theoretically as such, but practically you cannot do whatever you want like this. So arbitrage opportunity will depend on this, guys. In order to arrive at the amount of arbitrage gain or loss, you will have to show cash flow position, guys. Cash flow position mein you will show what is the cash flow as on the current date, and you will show what is the cash flow beta on expiry. That will depend on price on expiry. No matter what happens, the amount of arbitrage gain or loss will always be equal to the difference between actual forward price and fair forward price. Example के लिए assume कर रहा हूँ बेटा मैं अभी. Let us say spot price today is 1300. Fair forward price including borrowing cost is 1330, but actual forward price is 1350. If actual forward price is 1350, guys, is it overpriced? So what will you do on the current date beta? You will sell forward. If you are selling a forward contract, guys, you do not need to pay or receive any money beta theoretically. So cash flow will be 0. Opposite position you will do in the spot market. What will you do in the spot market? Buy at what price? Outflow of 1300. You will not want to put money from your pocket. So what will you do beta here? Borrow how much? Now assuming cash settlement, guys, settlement on expiry will all depend, guys, on what? price on expiry. I am assuming beta two prices. One is say beta 1310, the other one is 1400. Do not forget you have entered into a contract to sell at what price? 1350 guys. If the price is reducing, will you make a gain on settlement of forward? So if the price is 1310, how much gain will you make? 40. If the price is 1400, loss of 50. Did you buy spot? What will you do with this? Sell in the spot market. If the price is 1310, at what price will you sell? 1310. If the price is 1400, you will sell it. Should you repay your borrowing? With interest, beta repayment will be 1330. So no matter what happens as such guys, यहाँ पे तो cash flow zero था, यहाँ पे you will end up making a gain of, this is exactly the difference between actual forward price and fair forward price. Understood? So we did what is the meaning of the word forward, how to value forward with no storage cost, with no income, with storage cost. How do you settle a future on expiry, before expiry? And then how will you arrive at the amount of arbitrage gain or loss? Now coming to the next part guys. The whole objective of doing this as such guys was to arrive at hedging using stock index futures. You have portfolio of shares beta. If you have portfolio of shares and you are expecting guys the markets to, एक second beta, कहाँ गया यार वो? हाँ? One second guys, I just want to see if I wrote delivery settlement, cash settlement of forward underpriced. तुम्हारे नोट्स में इसके, हाँ गाइस बिफोर वी डू, चलो गाइस आई विल टॉक अबाउट कॉन्टैंगो, ये भी लिखा था ना क्लास में. डिड वी राइट ऑल ऑफ दिस इन द क्लास गाइस? सो arbitrage opportunity done better. After that basis, the difference guys between forward price and spot price is called as basis. But how do you write basis guys? Spot minus forward, not forward minus spot. That means by default basis will be negative guys. By default beta apna basis should be negative. What do you think will happen to this basis guys over the period of maturity period? It will come down to zero. This process beta is called as convergence. The process of the difference between spot and future price becoming zero is called as convergence. By default beta forward will be trading at a premium. That means basis should be negative. Such a market beta is called as contango market. Backwardation guys or inverted market is basically where a forward is trading at a discount. If forward is trading at a discount, your basis should be positive. That is backwardation. There was one question in which they have asked us to compute guys how much is contango or backwardation. You simply have to write the difference guys, nothing else. Are we clear? इसके बाद में बेटा क्लास में सिखाया था hedging of portfolio. Now guys, when you are hedging your portfolio guys, there are two alternatives that we did in the class. One is hedging using risk-free securities. The other one beta is hedging using stock index futures. In both the cases, always compute beta of your overall portfolio first. Beta of your overall portfolio guys will be weighted average beta. Just if you look at the example in front of the screen beta, यहाँ पे we have certain investments made. Should I go back to the same example that I took for you guys? Take second beta. 147 sides only. 1 second. This is option valuation. अरे आना भाई. अरे. Basis. All right. यही था ना? Hedging of portfolio as such guys. So we took an example guys of a portfolio beta wherein we had investment in 3 securities, 10,000, 20,000, 30,000 shares guys. We have value of investments, we have beta of individual stocks. Our existing beta guys was 1.2923. Now existing beta 1.2923 matlab kya guys? Whenever market fluctuates by 1%, our portfolio is expected to fluctuate by 1.2923%. So if at all you're expecting the markets to decrease as such guys, undoubtedly you're also expecting that your portfolio is going to reduce. In order to hedge your portfolio as such guys, first option is to use risk-free securities. Under risk-free securities guys, a part of your investment will be shifted to risk-free securities which will have a zero beta. This will directly beta reduce the overall risk. If they ask us to hedge 50% of your portfolio, guys, you will shift 50% of your investment from equity to debt securities. If they ask us to hedge 100% of the portfolio, you will shift 100% of your investment from equity to debt. If they ask us to increase the amount of risk, you are going to borrow money as such, guys, and invest more in equity securities. Remember, you are not going to invest from your pocket as such, beta. Door band karo. You are not going to invest from your pocket as such, guys. You are going to invest from by borrowing money. If you are investing out of your own pocket, guys, what is the significance? Absolute return will increase, but the risk in relative terms remains constant. When the risk in relative terms will increase? I'm borrowing money as such, guys, and I'm not investing from my pocket. Only then the risk is going to increase. So this is what you will do better for hedging using risk-free securities. Just यहाँ पे beta I said, if you look at the example on the screen, objective was to hedge 50% risk. So we shifted 50% of our investment to debt, which had a zero beta. Overall beta of the portfolio came down to 0.64615. Are we clear about this? Or if they give us desired beta, guys, जैसे अभी existing beta is 1.2923. They tell us beta that your desired beta is 0.8. What will you do? 0.8 is equal to weight of equity into 1.2923 plus weight of debt into 0. Beta of debt will be 0, right, guys? So by doing this, you will arrive at the missing figure, that is weight of equity. The balance amount beta will get invested in debt. Either they will directly specify that you have to hedge 50% of your portfolio, or they will give us what, guys? Desired beta. If they give desired beta, this is how you're going to compute. This is the first way of hedging. Second way of hedging beta is using what? Stock index futures. You can refer to the class notes, you will know the exact derivation. But what are we going to do beta is, you are not hedging a portfolio, guys, using futures of the same stock. If you hedge your portfolio using futures of the same stock, the relation will be 1:1. But because you're using stock index futures to hedge your portfolio, what do you need? Hedge ratio. And that hedge ratio here is given by beta factor. Whenever you're hedging your portfolio using stock index futures, guys, you will have to know the beta of your portfolio, because that is the proportion by which index futures and your portfolio are going to change by. So here, guys, if you want to reduce the risk, you will take opposite position, guys, in stock index futures. If you want to increase your risk, you will take same position in the stock index futures. If it is for complete hedging as such, guys, the number of contracts of stock index futures to be traded. So, all right, look at the formula, guys, here. For the number of contracts to be traded, you will have to write value of portfolio multiplied by desired beta minus existing beta divided by value of one contract. If you want to completely hedge, guys, desired beta is 0. Complete hedge agar karna hai, desired beta is 0, guys. If it is partial hedging as such beta, you're going to write desired beta minus existing beta divided by value of one SIF. Always remember, guys, if it is complete hedging, you are going to take opposite position. Even if you would want to reduce risk, it is opposite position. If you would want to increase your risk as such, guys, only then you're going to take same position. Are we clear, guys? Now, not necessary, guys, that after hedging your net gain or loss should be 0. After hedging your net gain or loss will be 0 only if the actual movements as such, guys, were as per beta factors. But we have proved that beta in 1 or 2 questions that the actual movements were not as per beta factor, and that resulted in a heavy amount of gain or loss. Ek question mein batao, everything moved in the worst direction only. Whatever positions that you have taken, all of them resulted in a loss. Beta is an average mathematical relationship, not necessary that the actual movements as such beta in the stocks should be as per beta factor. That is why always remember that. Are we clear, guys? अभी अपने example में बेटा our value of the portfolio was 26 lakhs. If they ask us to completely hedge, beta, you're going to write 26 lakhs into 0 minus 1.2923 divided by value of one SIF. If they ask us to arrive at a desired beta of 0.8, you will write 26 lakhs into 0.8 minus 1.2923 divided by value of one SIF. समझ में आ रहा है नहीं आ रहा है, guys? For this value of one SIF, are you going to use fair forward price or actual forward price? Actual forward price. You can never enter into contracts as such, guys, at fair forward prices. You can always enter into contracts only based on actual forward price. सिर्फ ऐसे बोलने से नहीं होगा बेटा. This part of hedging is very, very important, guys, using stock index futures. There are so many questions that we did, you need to practice them. There's one small thing beta in relation to futures. Should we finish that also? ये सबको समझ में आ गया, guys? हाँ बेटा. Initial margin and maintenance margin. Whenever you enter into a futures contract as such, guys, I told you, in order to protect the interest of the brokers, guys, they are going to collect margin. That margin as such, guys, is called as initial margin. There will also be maintenance margin. Maintenance margin will be given, guys. Maintenance margin will be given whenever mark to market gain or losses beta that you arise from your futures contract will be adjusted against the amount of your initial margin. As and when the balance goes below the amount of maintenance margin, you should deposit more. But the amount that you're depositing more as such, guys, should result in you should increase the balance back to the amount of initial margin. Now, in case initial margin is not given in the question, guys, I told you to compute it based on normal distribution. Mu plus 3 standard deviation will become the amount of initial margin to be collected from the investors. You are going to collect this margin from both the buyer as well as the seller. जो लॉन्ग पोजीशन एंटर कर रहा है उसके लिए भी देयर इज मार्जिन, जो शॉर्ट पोजीशन एंटर कर रहा है उसके लिए भी देयर इज मार्जिन. आर वी क्लियर? Questions beta on this are also important. You will have to adjust mark to market gains or losses every day and then determine if the balance is going below maintenance margin. You will have to make an additional deposit and increase the balance back to the amount of initial margin. Are we clear about this, guys? समझ में आ गया? So valuation of futures, arbitrage opportunity of futures, guys, hedging using risk-free securities and futures, initial margin and maintenance margin. If you know them in this order, that is sufficient. Also remember, guys, whoever is watching these videos later also, this is not a replacement for your preparation. As and when you are going to prepare, if you have the concept notes in front of you as such beta and go through the video, you will quickly recollect the concepts. Then you can start solving the questions. It will be easier. Having zero knowledge about derivatives as such, guys, and then watching the video might not actually help as such beta, because you will have to understand the entire explanation. वो याद रखना, ठीक है? I'm ending the session now. YouTube students, I'm going to revise the remaining part later. I'm going to merge that with this. So that's it, brother. See you guys later. Bye-bye. All right, beta. Let's continue with the revision part first, guys, and then we'll move on to the other topic. So we were revising derivatives as such, guys. I'm done with the entire revision of futures, guys. Moving on to the concept of options, guys. The primary difference, guys, between a forward future contract and an option contract, guys, is that under an option contract there is a right created for one party and an obligation created for an other party. So option contract is defined, guys, basically an agreement under which as such, guys, someone will have a right to buy or sell at a predetermined price on a later date. Depending on whether the right created is right to buy or right to sell, guys, it will either be a call option or it will be a put option. A call option, guys, creates a right to buy for the holder of the option and it will create an obligation to sell for the other person. Likewise, put option as such beta will create a right to sell for the holder of the option and it will be creating an obligation to buy for the other person. Now remember, if you are entering into call option as such beta, samne wala has also entered into call option only. Samne wala did not enter into put option. The option contract will either create a right to buy or will create a right to sell. It cannot create right to buy as well as right to sell for both the parties. Classic example beta is ESOP. Is ESOP a call option or a put option? Call option, because the employees have the right to buy the shares from the company, guys, on a later date. If the employees exercise that right, then the company will be under an obligation as such beta to sell the shares to the employees of the company. We also spoke about callable bonds and puttable bonds as such, guys, in the first chapter. Callable bonds are those where the company has the right to buy back the bonds from the investors. Puttable bonds are those beta where the investors have the right to sell back the bonds to the company. Are we clear, guys? So here, guys, this is right to buy as well as right to sell. Call option and put option. Because the option holder as such, guys, will always be at an advantage and it is the option writer who's going to be at a loss as such, guys. The additional thing that arises under an option contract beta is premium. This premium does not arise as such, guys, under forward contract, because under forward contract it is an obligation to both the parties. Both the parties can be at a disadvantage or an advantage as such, guys. But under an option contract, because one party has the right as such beta, there will always be premium component. Who has to pay this premium to whom? Option holder will have to pay this premium to option writer for the right that is possessing, guys. This will be the only income as such beta that the option writer will have. Yahan pe beta I gave an example as such, guys, wherein we have the right to buy at 800 rupees and we have taken multiple prices on expiry. If you have a right to buy, guys, that is call option. You are going to exercise that option if the price prevailing on expiry is more than the exercise price. You should be able to exercise and buy at a lower price. So a call option is exercised only if the price on expiry is more than strike price. The price at which you have the right beta is called as your exercise price or strike price. I repeat, a call option will be exercised only if the price on expiry is more than the strike price. Likewise, beta, you will want to exercise put option only if you are getting a right to sell at a higher price. That means a put option beta will be exercised only if the price on expiry is less than the strike price. अब ये example में there are 4 different prices on expiry. We have 700, 750, 850 and 950 rupees. Strike price is 800. So call option will be exercised at a price of 850 and 950. Put option will be exercised at a price of 700 and 750. Whatever is the benefit beta that the call option holder is getting, that itself as such beta will become the loss for the option writer. Agar option holder को 50 rupees, 150 rupees आ रहा है, that means option writer has to pay that 50 rupees or 150 rupees. Now, the next thing that we have covered here beta is moneyness of an option. An option, guys, will be termed as in the money if it is favorable to exercise. An option will be termed as out of the money, guys, if it is not favorable to exercise the option. And if you are indifferent as such beta, then it will be at the money. Abhi apan sikhaya beta, abhi we have learned that a call option will be exercised if the price on expiry is more than strike price. Only then the option will be in the money. Likewise, guys, a put option will be in the money only if the price on expiry is less than the strike price. And guys, your option beta will be at the money if the price as such, guys, is equal to your strike price. After that beta, I spoke about intrinsic value and time value of a option. The option premium, what is intrinsic value, guys? If the option is already in the money, the excess value that is there as such beta over and above the strike price will be called as intrinsic value. Say for example, you have entered into an option, guys, that is to be exercised 3 months later at a strike price of 24,000 Nifty. But prevailing Nifty is 24,100. Because this is call option and strike price is 24,000 and prevailing price is 24,100. This Nifty will already be in the money. What is the intrinsic value here? 100. Value of an option can never be negative, guys. If it is not favorable to be exercised, if it is out of the money, at the money, we say intrinsic value is 0. If it is in the money, the difference between price prevailing and strike price will become your intrinsic value. However, the option premium that you pay as such, guys, for an option will be more than intrinsic value. The excess component that you are paying beta will become time value of an option. Practically speaking, time value beta can never be negative. Time value will always be there. The option premium that you are going to pay as such beta will always be more than the intrinsic value of an option. But अपन class में questions में देखे beta that in few questions option premium was less than intrinsic value. That's not possible, but then if at all you get intrinsic time value as such beta to be less than intrinsic value component, sorry, if at all you get time value as such beta to be negative, you will be restricting it to 0. Any option as such beta, you are not going to write it as negative. सबको intrinsic value और time value समझ में आ गया. So what is intrinsic value? If the option is in the money, the benefit that you receive is called as intrinsic value. The excess premium that you are paying over and above intrinsic value is called as time value component. Now, depending on when can you exercise an option beta, we have divided the options into American options, European options, guys, and Bermudan options. An American option can be exercised anytime on or before the expiry date. European option can be exercised only on the expiry date. Bermudan option can be exercised on specific dates before the expiry date, guys, and on the expiry date. All right. Practically, the options that prevail in the market, guys, are European options. You can always exit from a option beta that is trading in the market, but you cannot force the other person as such beta to exit. So that means for you to exit, you will have to find another person who's willing to take your position. So that is why as such, guys, we say that options are always European options. After this as such beta, ये हो गया guys, types of options, call option, put option, intrinsic value, time value. 1 second, guys. After this, guys, we moved on to, so most important questions, guys, will be based on those payoffs only. So based on payoff beta, they will ask us how much is the amount of premium that you are paying today. जैसे ये है beta, this is an example of a payoff. ठीक है, you will have to compute what is the amount of benefit that you're receiving on the expiry date, compare that with the amount of premium paid, and that will become your net gain or loss. I told you most common questions that comes from options beta will be computation of payoff only. Do not forget, guys, whether it is option writer or option holder, whether the option will be exercised or not will always depend on from the viewpoint of option holder only. Even if you're computing gain or loss from the viewpoint of option writer, doesn't make a difference. Only the holder of the option has got the right as such beta to exercise. The gain of an option holder as such, guys, is always unlimited. The loss will be limited to the amount of premium paid. Loss jo bhi hai beta, it will be limited to the amount of premium paid, guys, for an option holder. Gain will be unlimited. Likewise, guys, for the option writer, maximum gain will be premium received. Loss can be unlimited. So in order to arrive at break even price for a call option, guys, you will take strike price plus option premium paid. That will become the break even price. You have to at least recover the amount of option premium paid. That is why break even price for a call option beta will be strike price plus option premium. दिख रहा है बेटा यहाँ पे? Likewise for a put option as such, guys, break even price will be strike price minus option premium paid. Are we clear about this? Talking about option valuation methods, guys. After this, we have moved on to option valuation methods. As per ICI beta, we have three option valuation methods. There is risk neutralization model, binomial model, and Black-Scholes model. But I told you beta that we learned 5 option valuation methods. The first one is theoretical minimum price approach. The next one is expected gains approach, guys. After that beta, we have all the 3 models that are specified by ICI. Doesn't matter which option valuation method are we following, guys. The value of an option will always be equal to the present value of likely benefit that you're going to receive on the expiry date. Present value of likely benefit that we are going to receive on the expiry date. If the benefit on expiry is fixed at 80 rupees, value of option premium beta will become present value of 80. That's it. Now all of these methods beta differ only in terms of volatility. What are the likely prices that can prevail on the expiry date is what changes under all of these methods. That's the first method beta is theoretical minimum price approach. Under theoretical minimum price approach, no matter what happens as such beta, the price on expiry will be equal to fair forward price. Price on expiry is always equal to fair forward price. That is why, guys, in order to compute benefit on expiry, you will compare this fair forward price beta with the strike price. So either call option will have a value or put option will have a value. Both the options cannot have a value. Once you get that benefit on expiry, the present value of that will become your option premium. Formula kya likhe the beta? If you look at the example that is given on the screen as such beta, spot price is 1200, rate of interest is 12%, time period is 1 month. We first computed fair forward price. We compared that fair forward price with the strike price of 1150. We got benefit on expiry. The present value of that benefit beta became value of the option. You can directly write that formula beta as value of call option will be equal to S0 minus K into e power minus RT. Value of a put option beta will be ulta, K into e power minus RT minus S0. This is as per theoretical minimum price approach. The next one beta expected gains approach. Expected gains approach beta will consider limited prices on expiry. ये theoretical minimum price approach के formula से beta. Expected gains approach will consider limited prices on expiry. The corresponding probabilities will already be given. In order to arrive at benefit on expiry, you are first supposed to compare individual prices, guys, with the strike price. Please do not compare expected spot price with strike price. When I say expected spot price, do not multiply all the prices with the probabilities and then directly compare one single price with strike price. If you do that, you will be assuming beta that option is an obligation and not a right. You have to compare individual prices with strike price, then get benefit on expiry. Those benefit on expiries you're going to multiply by probabilities. Once you do that, you will get expected benefit on expiry. That expected benefit on expiry ka present value, guys, will become option premium. In few questions beta, they might ask you that compute this amount as such beta only as on the expiry date. If they're asking us only as on the expiry date, you do not have to discount it. Do not arrive at the present value. This is what beta expected gains approach. So theoretical minimum price approach where there's only one price possible on expiry. Under expected gains approach, multiple prices, but the corresponding probabilities will already be given. Moving on to the next part beta, which is risk neutralization model, guys, or binomial model. Under both the methods, guys, we consider only 2 prices that are possible on the expiry date, guys. Usually one price will be more than the prevailing spot price. The other price beta will be less than the prevailing spot price. What will not be given under risk neutralization model beta are excellent probabilities as such, guys. So our job as such beta will be to compute probabilities. Once you get probabilities as such, guys, uske baad mein the calculation is exactly same as expected gains approach. You will compute benefit on expiry as such beta by comparing value of option at each price multiplied by corresponding probabilities. To compute probabilities as such, guys, under risk neutralization model, जो भी 2 prices possible on expiry है, in our example it is 1320 and 1080. That beta, the average of 1320 and 1080 should be equated to fair forward price. Upper price into P up, lower price into P down should be compared with fair forward price. This will give us P up and P down. Once you get P up and P down, what are we supposed to do? Multiply by individual benefit on expiries, compute value of option on the expiry date, uske baad mein compute present value of that as such beta, and that will become value of the option. Are we clear? Only thing that you have to remember is P up and P down will not be given. We are supposed to compute P up and P down. There was one question in risk neutralization model in which beta they gave P up and P down in the question. I said do not consider that to compute fair value of the option. You will compute that only to get the likely benefit on expiry. Compare fair value of an option with that likely benefit on expiry and you will be computing what is the actual return that you have generated. Basically the option was mispriced. It was not fairly priced. So this is about risk neutralization model. Binomial model is a copy of risk neutralization model. Why do we say it's a copy beta? Because even binomial model considers only two prices. Because there are only two prices considered, guys, even under binomial model beta, we will compute same P up and P down. But guys, instead of directly equating average of upper price and lower price to fair forward price, I said use which formula, guys? R minus D divided by, this is the formula. Where what is R? Compounded value of 1 rupee beta is R depending on the rate of interest. D is downside movement. U is upside movement. If the stock price can increase by 20%, U will become 1.2. If the stock price can decrease by 20%, D will become 0.8. R will be compounded value of 1 rupee, that will be e power RT. Okay. Even this will give us the same probability as risk neutralization model, but then you're supposed to use this in order to compute probabilities. Iske baad mein all the calculations same. So if they use the word risk neutralization model, directly equate the average of lower price and upper price as beta to fair forward price. If they use the word binomial model, you will write P up as R minus D divided by U minus T. Now in both of these models beta, it is not compulsory that they have to give us only one period of increase or decrease. They can give us 2 periods of increase or decrease. Doesn't matter whether they give 2 periods or 3 periods or 4 periods, guys. Probability of upside movement and downside movement will always be based on one period of increase or decrease. You can consider any one period. Jaise yahan pe example mein beta, you see 2 periods of increase or decrease. You can compute probability of upside and downside movement either using this part as such beta, or you can compute using this part, or you can compute using this part. It will still remain same. The probabilities are not going to change. But for you to arrive at the value of the option, guys, first you use these two and then beta work backward. Yaad hai nahi hai? You use one second. You use these two beta, work backward. You use these two, you work backward. Then you use these two beta and you work backward to this price. This is how you'll be arriving at value of the call option. ये हो गया क्या बेटा? Risk neutralization and binomial model. Now one important thing beta is that under binomial model we use the word hedge ratio. Hedge ratio as such, guys, is now what happens when you are yesterday beta in the revision or in the same video beta revision mein futures mein I told you whenever you are hedging your portfolio of shares using stock index futures, you need beta factor. Why do we need beta factor? The movement of your portfolio may not match with the movement of index. That is why we need beta factor, that is establishing a relation between the movement of your portfolio with the movement of the index. Option beta is a right, it is not an obligation. That is why if the underlying price is changing by 1 rupee, not necessary that option premium should change by 1 rupee. I will talk about the 5 option Greeks after this. So isliye guys, even here we need hedge ratio. Hedge ratio will establish that relation by how much will the option premium change for every 1 rupee change in the underlying spot price. Option delta bolte hai isko. So that option delta, guys, under this is computed as what? C1 minus C2 divided by S1 minus S2. Yahan pe beta, if you look at this options, guys, we have two prices on expiry, 1320 and 1080 as such beta. C1 is 80 rupees, that is intrinsic value at the upper price. C2 is intrinsic value at the lower price. The difference between these two divided by S1 minus S2 beta will become your hedge ratio. So if at all they ask us to compute hedge ratio under binomial model, it will always be C1 minus C2 divided by S1 minus S2. I repeat, what are C1 and C2? Intrinsic values, value of option on expiry. S1, S2 are the two spot prices that are likely to prevail on expiry. If at all, ye dusra derivation tha, if you remember, guys. So if the hedge ratio is 0.5, in order to create a replicating portfolio under binomial model, for every one share that you trade in the option market, you're going to trade 0.5 shares in the spot market. If hedge ratio is 0.3, for every one share that you trade in the option market, you're going to trade 0.3 shares in the option market. ये पूरा derivation class में क्या था बेटा, as to how did we arrive at the value of the option beta using the other set of formulas. याद आ रहा है कुछ? So now guys, after this beta we moved on to Black and Scholes model. You remember? वो हो गया बेटा. Can I move to the other part now? We moved on to Black and Scholes model as better. The only difference between these two models, guys, and Black and Scholes model is that Black and Scholes models considers the fact that, one second, guys. Black and Scholes model as better considers the fact as such, guys, that the stock price need not be a discrete variable, it can be a continuous variable. If it is a continuous variable, that means better instead of only two likely prices on expiry, there can be multiple prices on expiry that are possible. All of this as such better will depend on the volatility of the underlying stock. So Black and Scholes is the only model that considers all the 5 variables properly. Spot price, strike price, rate of interest, time to maturity, volatility, standard deviation. All the 5 factors are properly considered as such, guys, under Black and Scholes model. So to arrive at value of an option as such, guys, under Black and Scholes model, you will need how to arrive at logarithms and how to compute probability as such, guys, under normal distribution. वो probability under normal distribution, guys, n of d1, n of d2 use होता है इसमें, which will be cumulative areas. So you should know how to use cumulative areas if they give one tail area or if they give two tail area in the question. Refer to class notes beta, you will know how to arrive at that one tail, two tail areas. So under Black and Scholes model beta, you will have to arrive at value of a call option as S0 minus, वही formula beta, k into e power minus RT. But S0 will be multiplied with n of d1, k into e power minus RT will be multiplied by n of d2. N of d1, guys, is nothing but the probability that the option is going to expire in the money, also known as option delta. N of d2 as such, guys, is how deep can the option go in the money if the option is expiring in the money. To compute d1 as such, guys, again you see the formula on the front screen as such beta, ln s by k plus r plus 0.5 of variance into t whole divided by standard deviation into root t. Depending on Brownian ref motion, d2 beta will be d1 minus standard deviation into root t. Once you compute d1, d2, what will be the next step? Compute n of d1 and n of d2. After that, you're going to use that formula beta to arrive at the value of the call option. Put option beta will be the other way around and n of minus d2, n of minus d1 aata. Are we clear, guys? That was under which model beta? Black and Scholes model. Concept notes for beta. After doing all of these option valuation models, we did option Greeks directly after this. Alright, guys, after this as such beta, we moved on to the concept of option Greeks. Option Greeks माने beta the impact on of different variables. ये जो 5 variables अभी अपन बात करें, guys, all of these 5 variables as such, guys, on your option valuation. Option delta as such, guys, basically talks about what will be the impact on your option premium for every 1 rupee change in the underlying spot price. So it is change in option premium divided by change in spot price. That becomes your option delta. Usually, guys, for our understanding, I told you, deep in the money options will have an option delta of closer to 1. Deep in the money beta, call options will have closer to 1. Deep out of the money, guys, call options will have closer to 0. At the money options beta, usually will have option delta closer to 0.5. Put option ka delta beta will always be negative because put option works in an opposite direction of the spot price. If the spot price increases, put option becomes unfavorable. So that is why beta put option premiums will reduce. So put options will have negative deltas, call options will have positive deltas. Delta itself as such, guys, is slope. It will not remain constant. The rate at which delta changes is given by gamma. That's the second option Greek. Gamma measures the rate at which delta changes as such, guys. I told you beta, at the money option is 0.5. Don't you think beta slowly if the stock price is continuously increasing, at the money option will become deep in the money? Don't you think option delta is gradually increasing from 0.5 to 1. So the rate at which option delta changes will be measured by gamma. The next one beta is Vega. What does Vega measure? Volatility. If the underlying standard deviation is changing as such, guys, what will be the impact on option premium is measured by Vega. Rho क्या measure करता है? Rate of interest. If the underlying interest rates are changing by 1%, guys, what will be the impact on option premium? Theta. For every 1 day reduction in time period, guys, by how much will your option premium reduce by will be measured by theta factor. Remember, guys, as the time to maturity reduces, time value component of an option will keep reducing. I told you during the first half of the maturity period, usually 1/3 time value jata hai. During the second half, 2/3. This is called as time decay of an option. Anyways, guys, after this beta, after we did option Greeks, we also did the concept of real options. यहाँ पे नहीं है real options. पहले exotic options पढ़ा के फिर real options में गया. Alright, guys, we have exotic options as such, guys, and after that as such beta we did real options. Exotic options is only a theory component as such beta that is covered. The first one is chooser option. मैं बोला सिर्फ नाम से याद रखना. Chooser में beta the option holder gets to decide whether it is a call option or a put option. The next one beta is compound option. Compound beta is on the expiry date, option holder will have the right to buy another option. Barrier option as such, guys. Barrier option mein main bola, it will, barrier is basically a constraint. So the option will get activated only if a specific price is breached as such, guys. After that beta we have binary option. Binary matlab only two outcomes. So the payoff as such, guys, on expiry will be equal to predetermined amount if a specific event occurs, otherwise it will be equal to 0. Asian option, guys, settlement will not be based on a specific price, it will be based on average price. Very good beta. Bermudan option already covered abhi. Basket option, underlying is not single security, it is a group of securities. Spread as such, guys, the word spread matlab difference. So here payoff will depend on the difference between price of two variables rather than it being dependent on price of only one variable. Look back option as such, guys. Look back mein kya bola beta main? You get to decide what will be the strike price depending on the maximum and the minimum price that the underlying security has achieved as such, guys, in the past. Are we clear about this? Next beta, moving on to real options. Real options beta are basically options in relation to your business investments, capital budgeting decisions related. Isme I said beta there is long call, there is long put, short call and short put. When you use the word long call as such beta, it basically means that you have the right to invest on a later date. This usually happens with most of the business decisions, guys. You might want to know what is the benefit as such, guys. If at all you want to delay the project, you can invest today or you can invest on a later date. That will become long call. What is long put, guys? Right to sell as such, guys, or abandon. Either you want to sell the business as such, guys, if it is not favorable, or you will abandon the business. Short call, short put as such beta is from the perspective of the other person. I said we have three types of real options beta, that is categories. We have growth option, abandonment option and timing option. Growth option matlab kya, guys? There are projects beta which have insignificant or negative NPVs as such, guys. Though they have negative NPVs for the time being, you're investing in them because they're going to contribute to the growth of the organization. Abandonment option abhi padaya beta, it is a right to exit. And timing option beta is basically you having a right to delay a project. It doesn't matter whether it is growth option, timing option as such, guys, or abandonment option. Inka option valuation method will still be based on the three option valuation methods that we did, guys. The three option valuation methods kya the? Risk neutralization model as such beta, binomial model and Black and Scholes model. But याद रखना एक Black and Scholes model में beta, when you're talking about timing option, delay factor आया था. The project life was 15 years. I said instead of directly taking rate of interest, also consider delay factor. 1 divided by 15. Every time you delay the project by 1 year, the cash flows were going to reduce by 6.67%. Just keep that in mind. बाकी पूरा exactly same है. Are we clear, guys? इसके बाद में क्या कर रहे थे बेटा? Alright, the last theory part that we did as such, guys, was credit derivatives. I said, guys, that financial risk of an instrument as such beta can easily be hedged as such, guys, by entering into multiple instruments. If you have currency risk, you enter into forwards and futures. If you have investment in debt securities as such, guys, you can immunize your portfolio. What cannot be normally hedged beta is default risk, credit risk. So to hedge that default risk or credit risk, we have two things beta. Credit derivatives. Credit derivatives where we had CDOs and CDS. CDOs as such, guys, are nothing but securitization process. You are creating securities out of debt obligations as such beta. So what under this there were three types that we did: cash CDO, synthetic CDO and arbitrage CDO. Cash CDO mein beta, an underlying receivable will be transferred to a special purpose vehicle. That special purpose vehicle is going to sell securities on the backing of those underlying receivables and pass on the money to the entity that is transferring those loans and advances. Did we exit from the underlying loans and receivable? Yes. That is why we say beta that the credit risk has been transferred. Synthetic CDO mein beta, we do not transfer the underlying receivables. Instead, what do we transfer? Only credit risk as such beta will be transferred to a special purpose vehicle. The investors of that special purpose vehicle will be obligated to give us money in case there is a default made. For this, the company will have to pay premium to the investors of SPV every year. So we pay them a premium. It's like insuring against credit risk. This can be either funded or unfunded. Funded beta is where the investors of SPV has brought in money, but that money has not been given to the entity. That money beta has been invested in risk, lesser risk securities, lower risk securities. So just in case beta default occurs, we can sell those securities and realize our money. Unfunded, there's no money brought in. Arbitrage CDO क्या बोला बेटा मैं? You are borrowing money as such beta at a lesser rate and investing in CDOs as such beta that is generating a higher return. Credit default swap mein beta, I said there can be multiple parties. You will have an investor as such guys, the one who's investing in debt securities or who has given loan to someone else. A borrower as such beta, the one who has borrowed money. And then there will be an option writer of the CDS as such guys. Option writer of the CDS is basically the person from whom you have taken an option. So credit default swap. If I have entered into an option as such guys, credit default swap with say Khushbu in respect of an underlying loan. So if there is a default that is occurring on an underlying loan as such beta, then Khushbu will be liable to pay me the amount. It is similar to a synthetic CDO, but synthetic CDO is with an entity, special purpose vehicle. Yahan pe you are entering into a transaction with a specific person. Again, under this, it can be cash settlement or physical settlement. Cash settlement, beta, Khushbu will only give me the difference between the actual amount and the current market value. Physical settlement, I will transfer this loan to Khushbu and she will pay me the entire cash. इसके अलावा बेटा there was electricity derivatives, weather derivatives, such guys towards the end. I said normal instruments hai. Are we clear guys? So that's the completion guys of derivative revision.